What are short selling and long selling as often mentioned in the news? Let me give you a typical scenario. Imagine a coffee shop where the barista announces the price of syrup is going up next week by $5 per cup. If you're a diehard fan, you'd likely buy an extra bottle to stock up. If your friend also loves it, you might even grab a bottle and charge them a little more when they ask for it later. This is essentially the logic of going long in finance. Conversely, imagine you work at this coffee shop and discover the supplier just delivered a huge batch of syrup, far exceeding the usual amount. Meanwhile, you hear a new tea shop on the corner is launching a cheaper honey lavender tea, which is already generating a lot of buzz on social media. You think the syrup price is bound to plummet, so you borrow a bottle from the manager and sell it to a customer for $10. The next week, the price indeed drops to $5, and you buy a bottle back for $5, making a net profit of $5. This is short selling, which sounds a bit like getting something for nothing, but as long as it's done compliantly, it's a completely legal financial operation. Going long, simply put, is buying low and selling high. You spend money to buy something now, whether it's stocks, commodities, or the aforementioned syrup, hoping the price will rise later, and then sell it to profit from the difference. This is the most intuitive investment method. Short selling, on the other hand, is essentially profiting from a price drop. You don't already own the asset, so you borrow it from someone else, sell it at the current high price, and then buy it back at a lower price to return it. The difference is your profit. However, short selling is much riskier than going long. With long selling, you might lose all your principal, but with short selling, the losses are theoretically unlimited. If the price not only doesn't fall, but keeps rising, you have to keep finding higher prices to buy it back and return it, and how much you lose depends entirely on how high the price rises. However, in the market, short selling and going long are not mutually exclusive. Many investors hold both long and short positions simultaneously. It is called hedging. Another term often associated with going long and short is leverage. Returning to the coffee example, you don't just buy one bottle of syrup, you borrow money from a friend and buy 10 bottles. This is using leverage to amplify your long position. If the syrup price actually rises by $5 per bottle, you'll now have a $50 profit, but if the syrup price falls by $5, you'll now have a $50 loss and have to repay your friend. Short sellers also frequently use leverage, which is the trigger for a short squeeze. Leverage amplifies both profits and losses, resulting in larger gains and larger losses. Speaking of short squeezes, you may have heard of the GameStop incident in 2021, which is the most classic example. Short sellers borrowed a large amount of GameStop stock and sold it, hoping the stock price would fall. As a result, retail investors on Reddit discovered this, and they collectively bought GameStop stock like crazy, driving the price higher and higher. Short sellers suffered increasing losses and were eventually forced to cut their losses and leave the market. This is a short squeeze, essentially retail investors uniting to fight back against the short-selling institutions. However, don't think of short selling as a bad operation. Short sellers are essentially the market's woodpeckers. For example, some companies inflate their stock prices by fabricating financial statements. Short sellers conduct in-depth research, discover problems, short these companies' stocks, and publish reports exposing the fraudulent activities. This causes the stock price to fall to its true value. To some extent, this also protects other unsuspecting investors from being taken advantage of. Besides stocks, going long and short are also common in other assets, such as commodities like wheat. Farmers can short wheat futures before harvest, agreeing to sell the wheat at a certain price later. This is because they worry about wheat prices falling after harvest. Locking in the price beforehand ensures they can receive the agreed-upon higher price even if prices drop. Conversely, bakeries might go long on wheat futures to lock in costs in case wheat prices rise later. This is a common form of hedging used by businesses, essentially an application of going long and short. From going long and short, we can also develop long-short funds, a common strategy among hedge funds. For example, a long-short fund might go long on Apple stock, believing Apple will rise, while shorting Samsung stock, believing Samsung will be worse than Apple. Regardless of whether the overall market rises or falls, as long as Apple's price increase is greater than Samsung's or Apple's price decrease is less than Samsung's, the fund will profit. This strategy doesn't rely on the overall market trend. It depends entirely on the relative performance of the long and short assets, making it a more advanced approach. It's crucial to remind everyone that shorting and leverage are very risky. Even professional traders often suffer losses. If you're a beginner, I suggest starting with long positions, buying stocks of companies you understand and holding them long term. Understanding short selling helps you better understand market dynamics and avoid being taken advantage of. If you'd like to delve deeper into topics like short squeezes, hedging, and cryptocurrency trading, feel free to leave a comment. That's all for today.